Microsoft and Meta report earnings this Wednesday. Stock analysis. Welcome back, investors. This week on the Investment Diary, we're diving headfirst into what's shaping up to be the busiest and most impactful earnings week of the entire season. Prepare yourselves, because we're talking about a lineup of absolute juggernauts. Microsoft, Meta, Apple, and Amazon are all set to report. This isn't just another week of earnings. This is the one that I believe will most significantly move the S&P 500, either propelling it higher or causing a pullback. If you're getting value from this video, please subscribe to the channel. We just passed 50 subscribers, so a huge thank you to everyone who's followed the Investment Diary. Now, let's dive into it. On Wednesday, after market close, both Microsoft and Meta are reporting earnings simultaneously. Let's start with Microsoft. The first thing I have to say about Microsoft is that I've owned this company for quite some time, and I have been consistently bullish on it. It has been one of my high conviction and hold for long-term positions. Even with Microsoft currently trading at a share price of $513, I refuse to trim this company. Microsoft exemplifies some of the most ideal fundamentals you'll ever see. Its long-term revenue growth is simply gorgeous. The diversification of revenue, both by segment and geography, is incredibly robust. It's not just diversification, it's high-quality diversification, with all revenue segments performing exceptionally well. You have a highly profitable business model centered around software, which has been an incredible space to be in, characterized by highly recurring revenue, strong lock-in, high lifetime value, and excellent margins. And then there's cash flow generation. Their free cash flow has literally gone parabolic over the past couple of years, from 2018 to the present day, even with massive capital expenditure investments, which are directly subtracted from their free cash flow continues to grow. Microsoft is truly exceptional. While most people understood that Microsoft was a great company, they perhaps didn't fully grasp just how good it was, or how much it would truly persevere and grow to this extent. When we consider Microsoft today, the big question, or perhaps problem, is the company's valuation. If we examine its valuation over the past 5 years and look at the free cash flow yield, a lower yield indicates a more expensive Microsoft. Microsoft is trading at almost double the valuation it did just a couple of years ago on a price-to-earnings ratio. This ratio is inverted, meaning the higher the chart, the more expensive Microsoft is. Again, in 2022, when the stock was around $220 per share, it was trading at a 26 PE ratio, which was the cheapest Microsoft had traded in a long time. It typically trades in the high 30s, reflecting the company's quality. More recently, however, it's at its most expensive point, right at the peaks over the past 5 years. So, Microsoft is trading at a higher valuation today than almost any time throughout its history. However, Microsoft does possess more fundamental differences today to justify this elevated valuation than it did even a couple of years ago. This company is undergoing a transformation for the better, a shift being highlighted by CEO Satya Nadella. He recently released a memo titled, "Recommitting to our why, what, and how." While this memo is several pages long, I'll summarize its overall theme and Nadella's key arguments. Nadella argues that Microsoft has historically been known as a software company, building and selling applications with a residual license model, but he asserts that their identity is transforming. They will no longer be viewed, or even operate, primarily as a software company. Instead, they are becoming an intelligence engine, powering the rest of the world with AI solutions and tools. They are now primarily an AI company. AI first, not a software company. Everything they're doing with Azure and their other builds is specifically designed with AI to power other companies with AI. This also shifts their priorities, with a greater focus on security and the quality of their tools. As they transition from a software company to an AI company, in this process, they are conducting layoffs, a regular restructuring practice for Microsoft, which typically sees layoffs followed by significant hiring in the future. You can clearly see this transformation unfolding. They're no longer trying to be an old-fashioned software company, but an AI engine company. I believe this is the correct vision for the company, and Satya Nadella continues to transform Microsoft in a positive way. He first demonstrated this by leading Microsoft headfirst into Microsoft Azure, which proved to be the right strategic direction for the company. Now, transitioning from software into artificial intelligence is another smart move for Microsoft. For investors, Azure growth and dynamics, along with AI integration, are top of mind. Investors should closely monitor Azure's growth trajectory. The evolving blend of AI and non-AI workloads on Azure means that demand trends and revenue benefits might become increasingly difficult to disentangle, and the continued success of both components will be vital. Andy Jassy of Amazon also highlights this, noting that while AI is great, there's still a vast amount of basic IT work that needs to migrate to the cloud. So, while Microsoft is pushing full steam ahead with AI, there are still many workloads being done locally that should be cloud-based, which contributes to Azure's growth. We want to see strong AI growth and overall growth. The next key area is cloud infrastructure, investments, and capacity constraints. We recently saw Google increase their cloud investments, which puts significant pressure on Microsoft. As a reminder, Google Cloud's cloud backlog grew by 37.5%, almost 38%, to $18 billion. This means they have a massive and rapidly growing backlog. Microsoft will face pressure to demonstrate continued capacity, constraint, and continued investment in Microsoft Azure. We also want to see Copilot and AI product monetization tracking, including adoption rates and customer engagement on Copilot and other AI-driven products across Microsoft Dynamics 365 and their security solutions. While some may criticize Copilot as just an add-on AI, the reality is that many existing Microsoft service users will simply sign up for whatever integrates most easily or is already bundled into their package, which is Copilot. Microsoft is effectively leveraging its bundling and vast offerings to enhance Microsoft consistently balances maintaining high margins with making meaningful investments, and they are exceptionally good at this. They only invest where they foresee a high return. Therefore, if Microsoft increases its CapEx, I will view that as a positive sign. I won't sell my stock or be concerned if CapEx goes up, even if it leads to a temporary hit to margins. I'd be perfectly fine with Microsoft undertaking more CapEx, especially given how strong their cloud business already is. Overall, despite a share price of $513 and the fact that this company trades at a 5-year high valuation, I'm still not selling because it's in such a fundamentally strong position. The price may ebb and flow a bit. I could see it moving up or down a couple of percentage points after earnings. But fundamentally, this company is so robust that even though I don't think it's the absolute best time to buy into Microsoft, I'm certainly not selling my shares. I believe it will continue to exhibit incredibly strong fundamentals. Now, next up, reporting at the same time, we have Meta. This is a company that, no matter how big it gets, always seems to have room to get even bigger. It consistently impresses me how many people continue to use their services. For example, the family daily active people metric was at 2 billion in 2019. And has steadily grown quarter after quarter, now reaching 3.43 billion. I believe this figure will continue to climb, showcasing the massive total addressable market for these types of companies. They offer free, ad-supported applications that virtually anyone on Earth with a mobile device can use. So Meta is constantly expanding the number of people using its service, and then it's growing revenue from its existing user base year-over-year, leading to a top-line growth rate of around 20% year-over-year, which is one of the fastest among big tech companies. Like all of these major tech players, Meta has had to integrate AI into every aspect of its business. They've obviously done this to optimize their advertisements, but now they're taking it a step further, doing things similar to Amazon with generative ads recommended by their GM model. Essentially, what Mark Zuckerberg is trying to achieve here is to enable an advertiser to simply click a button or type in what they want their advertisement to be about, and the GM model will then create that ad for the advertiser, who can then sell it on Meta's platform. I really like this idea. If an advertiser can save money and time on building the ad itself, they can then allocate more of that saved money and time towards actually paying for ads to be run. Meta is actively trying to automate a portion of the advertiser's job to encourage them to spend more money on Meta. And I think overall, that's a great plan. The other big thing, like any of these big tech companies, is going to be looking at their infrastructure. This company used to be looked at as just a social media company, but now it's viewed more as the rails of communication across the globe. They own so many assets and are building such huge infrastructure, wrapping all of this with AI, that it has become a much more high-moat company. It now possesses a durable logistical moat and even a technological moat. Now, in terms of how the stock will trade, it's always a coin flip. But with Meta, there's reason to believe that it might cool off a little more than expected. The company trades at a valuation of a 27 PE ratio, whereas you have other companies like Google trading at around an 80. Right now, I believe that Google is the undervalued one. I think Meta is at more of a full valuation, and if anything, I believe that Google should eventually reach a similar valuation to Meta, somewhere around a 25 to 26 forward pay ratio. This suggests more upside for an advertising giant like Google than there is for Meta. What you're essentially buying with Meta at this point is that you never truly know. This company has wildly outperformed investor and analyst expectations before, so there's always a chance they could do it again and come in way above expectations. With that, I think I'll leave it here. If you got value from this video, please subscribe to the channel. If you agree or disagree with anything I said, let me know in the comments below. And if there's a company you specifically want me to dive into, let me know in the comments section too. I hope to see you in my next dive.